I know Fannie and its sister company, Freddie Mac, buy and package mortgages into bonds and absorb the risk. This was the case before the Great Recession, and it remains the case now. There's obviously been a change in ownership, but I wonder, let's begin our conversation with looking at how operationally the business has changed since you joined in 2009.
Sure. Well, I guess I'd point to two things fundamentally. One is, before the crisis, we bought loans basically on the promise of lenders that their loans conform to our standards. We didn't really have any way to inspect what was in those loans until after there was a problem. But today, through technology, we're actually able to verify borrower income, borrower assets, the collateral value of the property digitally. We've created a digital mortgage process, so we're actually able to absorb that data and inspect those loans before they're even closed to the borrower, let alone delivered to us. So that's one important change.
So it's quality assurance.
It's really quality assurance. We've reduced the risk of underwriting dramatically. The second thing is that for a long time, historically what we did is we would acquire mortgage loans and we would hold that credit risk for the life of those loans. So if you had a 30-year loan, we held the credit risk for all that time. Today, we distribute that credit risk to lots of other private capital players. So mortgage insurers, capital markets transactions, reinsurance players. So we're really becoming a distributor of that risk, applying our own risk management techniques, but using the same data that we use to acquire loans to show that credit risk to others, and they buy that without any guarantee from us.
So they don't get a separate read on how good the quality of those mortgages are? They go with what you've done in terms of your technology?
They're free to inspect the loans themselves, but they think they have great confidence in what we do, because our interest is aligned with theirs. Because we don't sell all the risk to them, we sell a part of it. And so they know that we're bearing some of that credit risk, as are they. And so they have confidence in our risk management techniques. But it's really been a great way to take risk and distribute it away from taxpayers and give it to private capital.
How much demand has there been from the private party side then for these kinds of mortgages?
Considerably. I'd say just 4 or 5 years ago, there really was no market for this kind of credit risk transfer activity. So this is a market we started from scratch basically 4 or 5 years ago. And that market has grown and deepened and diversified over time. So initial investors were people like hedge funds, but today we have very traditional asset managers who are interested in taking that mortgage credit.
How big do you think this program can get? And I ask because a lot of people here are talking about the prospect of a downturn or recession in a couple years' time. Can it work in a downturn?
Well, I often caution policymakers that not to become too dependent on current market conditions, because they will change over time. But one of the things we've been doing is focusing on more long-term commitments from the people who buy this credit risk. So a capital markets transaction, you're dependent on the market on that day. Will somebody buy it that day? But these reinsurance type of transactions that we're doing where we get long-term commitments to buy this credit provides a more stable solution. So to us, the answer is not one single source of capital, but really building a portfolio of these executions.
And what are you doing with that revenue that you bring in?
So when we bring in revenue, but we're transferring some of the risk, but we're also transferring some of the revenue that would have come to us. So that's how those risk takers are being compensated. So the good thing for us is that we still have a stable, reliable business. We still are profitable, but we're able to share both the revenue and the risk with others and take some of that risk away from taxpayers.
Let's take a step back here for a moment, because I wonder, from where you sit, is there a significant disconnect right now between what American homebuyers want and the financing that's available to them?
Look, I think the great challenge in housing today is really around affordability. Housing markets have recovered dramatically. We've seen a lot of home price appreciation. That's a fundamentally good thing. But one of the challenges is that there's very little supply, especially at the entry level, for first-time home buyers. And so that's where the real pressure is. So I think that there is not so much challenge in terms of the financing that's available, but just the supply of homes. Many of those starter homes, you're not seeing people trade up to bigger houses, so there's not as much supply available. And new home starts have been down. And the new homes that are getting built tend to be bigger, more expensive homes, not starter homes.
All right, so the demand has been coming back with the recovery, but the supply isn't there. We know that lawmakers in Washington have been working on housing finance reform for, a decade now. But my question to you is, does it need to happen? Because federal control of Fannie and Freddie Mac have lasted for about 10 years, and the mortgage market does appear to be working pretty well. Why risk shaking up the system with housing reform at all if it's going okay?
Well, look, I don't think conservatorship was ever anticipated to be a long-term solution. Yes, we've been able to make this system work, and I think it's functioning pretty well. But the fact is, Fannie and Freddie are currently operating with extremely little capital, and so we haven't really provided the kind of long-term buffer for that, so taxpayers are still exposed, and that's something we should fix. But the good news is that the starting point for that debate is much different today than it was 10 years ago. We've made a lot of money. We've sent $50 billion in the case of Fannie Mae, $50 billion more back to taxpayers than we took. But we've also instituted some of these other reforms that we've talked about. And so what needs to happen is much more limited than what people might have thought about 10 years ago when they were talking about starting from scratch.
Right, the level of urgency is different. Having said that, explain why Fannie needed to take government bailout money in March for the first time since 2008. Because for some, that might reinforce the perception that the federal government would just bail out Fannie and Freddie again if they ever ran into trouble.
So the reason we had to take a draw from the Treasury in March was because of the new tax bill. And basically, it reduced corporate tax rates. And we have things on our balance sheet called deferred tax assets, which are basically an estimate about what our future tax liabilities are. If you reduce the tax rate, the value of those assets goes down as an accounting matter. So we had to report that on our financial statements. But it had nothing to do with the underlying fundamentals of our business. Our revenues are still strong, and so it really had nothing to do with the underlying business. It just had to do with an accounting effect as a result of the tax bill, and it's a one-time event.
A one-time event not to repeat it next year.
That's correct.
All right, Tim Mayopoulos, CEO of Fannie Mae, thank you so much for joining us.
Thank you.